Hi, my name is Joel Gilgard with Gilgard Analytics. Thank you for tuning in to this YouTube video. This is a tutorial and we are going to cover the most recent quarterly numbers for NASDAQ and New York Stock Exchange from Gilgard Analytics perspective. And the idea is that, for every quarter going forward, this file that's out on our website will stay the same, and we're hoping that the information here will be of value for our viewers. So starting out here in the Notes tab, we cover a number of topics. Excuse me. So basically, the Gilgard Analytics, we review approximately 2,100 companies in the NASDAQ and the New York Stock Exchange. And the way we filter these is we have to have continuous trading data for the past 8 years. And likewise, we want the market cap to be at least 750 million. Now, there are some companies, if we're interested in, we might have position in, we might cover those as well. So what do we look at? Well, first we want to show the number of companies, and this is from a sector perspective, and there are 11 sectors here that we cover. We also look at what we call wealth destruction, and so this is a number where we go in and analyze to see if a company has created positive returns for at least the past 5 years or going further back in time. So if it hasn't, if it's lost wealth, we basically call this a wealth destruction company, and it has to have generated at least 5% return, and this goes in some cases all the way back to 34 years. We look at the number of employees, we look at market cap, because market cap is an important factor when selecting companies to invest in. We see how old the company is. There tends to be some correlation between how old the company is. If it's survived, it's likely to survive into the future as well. That's called the Lindsay rule. Look at CEO pay. We look at the ranking of companies, and what we mean by this is the size, right? So ranking in size. I'll put that. I need to just change that real quick here. We look at revenue, and revenue is also in billions. And earnings, and so this is net earnings, cash on hand, dividend yield, percentage companies that pay dividends in the sector, debt, book value per share, operating cash flow, and also price per share. There is a fairly strong correlation between how strong a company is and how high the price of a stock is. Now, the next couple of numbers we look at are numbers that Gilgard Analytics puts together. So the average dividend score, the lower the score, the more favorable it is. The CEO score, the more favorable it is. The average purchase amount. And so this is approximately from a $3 million portfolio. Each of the various underlying companies, the estimate is that you buy approximately 5 times. So it's a very spread out portfolio. Low volatility count. Looks at a series of different indicators, but basically the lower the score, the less volatile a company is. and there's neither, and nothing intrinsically good or bad. It just tends to be, the better the company, the less volatile it is. Likewise, we look at what we call a high speculation count. And again, the lower the count, the more speculative it is. And basically, this is how much cash does a company have in hand, how much does it move in price, those kind of things. And there's nothing inherently good or bad by this number. I also look at finance ranking. So there are approximately 8 variables that we look at, and we rank them and add them up. Debt ranking is also included. And again, the lower the score, the more favorable it is. We look at PE ratio, net income to revenue, price to book value, debt to market cap, revenue to market cap, operating cash flow to market cap, cash to market cap, and then again, debt to revenue. And so there are many more numbers that you could look at, accounting, financial ratios. My opinion is, and this might even be too many here, is you have to put a cap on it, right? We're not going to try to boil the ocean. We can't just measure everything. But this will give the viewer a general understanding of the sector, and then also the company. As always, this is going to be in a matrix format. I'm going to make this just a little bit smaller so we can see. So we have the number, and then we also look at the delta. The delta is very important. So for example, the employees. And what I'm going to do is, I'm not going to go through each sector. I am going to focus in on the overall market. So I add up the New York Stock Exchange and NASDAQ. In this particular quarter, we had about 2172. My goal is to get this number down. I started high. I'm going to get this down to probably below 2,000 that we look at. So you can see the number of companies that changed, went down. Now, out of these 2172 companies, 2,172 companies, a little bit less than half have destroyed wealth. And what I mean by destroyed wealth is, you put in $100, you will get less than that back with dividends. And one of the goals is to assist the viewer with investing in those companies that are not wealth destroyers in the long run. The average company, big board company, so basically you can look at this as the Russell 2000, has an average of 23,500 employees. This has gone up slightly, so this might explain the tightness in the labor market. The company has an average of 24 billion in value. As this market cap has gone up by 6% since the last quarter. The average company on the New York Stock Exchange and NASDAQ is approximately 62 years of age. And you can see here the top 100 companies is approximately 30 years older, so 92 years of age, somewhere in that range, 93 maybe, 92. CEO pay is 3.1 million. It's gone down slightly, and this is just a number of ranking, because with the number of companies that are being analyzed has gone down. Revenue And these are annual revenues, but it's just for the last quarter. It's approximately 12 billion, and revenue went up slightly, and earnings 1.1 billion on average per company, and earnings went up by approximately 5%. Cash on hand is roughly 9 billion. That fell slightly. Dividend yield 2.26 went up slightly. The number of companies that pay dividends is about 2/3, fairly stable there. Debt at 11 billion. And so here is a recurring theme for this past quarter is that debt increased by approximately 35% across the board. The average book value is $189. This has gone up, and so what this tells us, not exactly, but companies are investing. They've increased their investments in their companies by approximately 8%. Operating cash flow is a positive 2 billion, which went up by about 23%. The average price per share is $320. That went up by approximately 7%. And so you might go, oh, wait a minute. We know that the S&P 500 went up a lot more, which is true. But the S&P 500 is skewed. But basically, it's weighted by the by the size of the company. Need to just get a little water here. And the way Gilgard Analytics looks at this is that it basically each company is included and weighted by itself. So here, it's nothing to, the S&P 500 that's been around for a long time. They do a fantastic job. Their portfolio. This just gives you a more raw view of what the average company is doing, rather than what a weighted portfolio is doing. This number here, the average dividend score, is a compilation of various attributes of a company. And so the way to look at this is just the average, right? So you can see what makes this more interesting is which sector has the strongest dividends. And so the utilities has the lowest. Which sector has the worst dividends, the weakest dividends? That would be healthcare. And the CEO score ranking, so the average would be 3.5. So where do you get the best value for your money from CEOs? From utilities. And where are you not getting value from your CEOs? That is actually, take that back, that is healthcare. So healthcare CEOs are paid too much on average. The average amount when Gilgard Analytics makes a buy, this is from a portfolio of approximately 3 million, is $383. This is an average, right? So the area where the biggest buys are made currently are into the industrials, and where the least amount is being made right now is into communications. And I'm just wondering, if it's the internet, the Zoom, the all of these available applications where you can pretty much get a phone for $10 a month. How big of an effect it is having on communications. So the next area that we look at is volatility. And so volatility, this is a Gilgad Analytics number, and so it has some, 5 or 6 variables that it looks at, and so this number here just gives you an understanding of how much a price goes up and down on average, right? So it looks at standard deviation. It looks at when the market crashes, how far does a sector go down? It looks at what else does it? It looks at 3 things. It looks at the stock market crash. It looks at the standard deviation. And there's one third that I just apologize, can't remember right now. But these are compiled, and the way to look at this is this is the baseline, right? So the New York Stock Exchange, NASDAQ is the baseline, and the not surprisingly, utilities is the least volatile sector. The most volatile sector is healthcare. The speculative sectors. So this is there's some variables that we look at, right? So this means that they're very volatile. It means that they have a good cash on hand. They have high earnings. You favor older companies because they've been around longer. They can, they have experience in their organization to handle volatility, etc. And so, so the way to look at this is the least speculative sector is real estate, followed shortly thereafter with utilities. Makes kind of sense. The most speculative sector is energy. And the next topic here, the next variable is financial ranking. And so the average is 3.5. So where do we find the strongest ranked sector? That is the finance sector. Even with all the turmoil that's gone on, they still have the best numbers. Which sector has the worst numbers right now? Which is healthcare. And the last variable that we look at is debt ranking. And the average score, the New York Stock Exchange, NASDAQ, is 3.5. And so the companies that have the most debt, real estate and utilities. And this doesn't necessarily mean that this is bad. It's just they have a lot of debt, right? The companies that have the least amount of debt is industrials, healthcare, energy, and the defensive and materials. Now, moving down this spreadsheet, we've created graphs so you can see, right? Just basically what area, so you can just visually see the numbers. Haven't done the deltas in this yet. It might be something I'll do in the future. But so I'll just walk through and so you can see these. So this looks at the percentage wealth destroyers. As I mentioned earlier, the communications sector is high up. Likewise, the bottom 100 sized companies are, so basically the bottom 100 is just the smallest companies. And here you have the top 100. These are the largest in size. This chart shows the number of average employees. So you can see, real estate has very few. The smallest companies have few as well. That makes sense. Defensive industries like Walmart, they have the most. Cyclical some automotive. They also have a lot of folks. Market cap, this is how large they are. So you can see the top 100 companies, they really dominate. The information technology sector, they're pretty big as well. Likewise, I think the defensive is number 2. Average age of a company. So we see here the defensive. So these are department stores, grocery stores, things like that. They're pretty old. Utilities, they're also fairly old, along with the banking industry. The newest sector is real estate, followed by technology and communication. CEO pay, so this is interesting. The sector that's doing the worst also pays their CEOs the most. Right? And I am a frugal person. I don't mind paying good money for Mercedes or for what, but I want to get value for my money. And to me, it doesn't quite look like you're getting value for your money here. They're the worst performing sector. And this gives you an indication of where in the size ranking, if you average up each of these sectors, where do they rank up, right? And so, for example, the utilities, they have on average, they're the largest companies in the stock market. Whereas real estate, they are on average the smallest. And you can see here the top 100 companies, they are on average the largest, which makes sense. These two, they speak for themselves. The average revenue per company, you can see energy is on top, followed by the defensive. Likewise, the top 100 companies, they trounce everyone. Earnings is energy. Financials, they have the highest amount of cash on board. They kind of make everyone else look a little small. Average dividend yield. So right now, real estate is paying the highest dividend. Likewise, energy and the financial sector. And so this is just general opinion, but the higher the dividend yield, like if it's really, really extreme, the more cautious you should be, right? Dividend, the dividend the company pays, the analysis that we do, this is the dividend ranking, plays a big part in Gilgard Analytics ranking of companies that you should be buying, right? But so this will give you a good understanding. If you see a real estate company that's paying 18% dividends, that would be an immediate red flag that would go up. Basically, this company, there's something wrong, right? So when price goes down, the dividend yield from the previous quarter will make it look high. And that's the same thing, say, with the healthcare sector. It pays the lowest, has the lowest dividend yield. But if you see a healthcare company that's paying, 5%, alarms should be going up, alarm bells, right? Utilities, if you see a utility company paying 8%, and then likewise, if you see a utility company only paying 1%, it means maybe they reduce their dividends. It's something to be investigated, right? So these are just averages, and this looks at the average percentage of companies that pay dividends, right? So in the healthcare sector, only 20% pay dividends, so that's not really a big deal if they don't. But a utility company that doesn't pay dividends, you have to ask yourself why. And that's the same thing with real estate and the banking and the materials. Average debt per company, the finance and the communication, they by far have the most debt. Average book value per company. This is Warren Buffett that's skewing these numbers. I've been thinking of just removing him to get a better look at it. But you'll have to look at then. What I advise you to do is to just look at each sector and compare it to the others. From a quarter to a quarter, quarter-over-quarter review. Average cash flow. The energy sector is doing very, very well. One way of looking at this is they might not be really investing anymore. I'm not sure about the real estate sector. They might just have very low cash flow because they're not investing. So that's something that you need to dig into deeper. Average price per share, again, this is skewed by Warren Buffett. But believe it or not, the average size of the price, right? How large the price is, the bigger the price of a company's share, the more likely the company is good. It's a safe company to invest in. It's not a 1-to-1, but it's an indication. So let's look here. This is the average dividend score. So this is a number that we look at. The smaller the number, the better, right? So here we have healthcare. Very few companies pay dividends, and those that do pay very little. But their ranking, right? The dividend score, how strong the company is. It's pretty weak, right? So don't look to healthcare for dividends. The strongest are utilities. They have a very good dividend score. It's a lower ranking number. Financials are also pretty good. Real estate also seems to be reasonable. Where do you get the best bang for your buck for CEOs? It looks like utilities. We already mentioned that earlier, I guess. And you also get very good value for your CEO pay for the top 100 companies. It's reflexive, right? It's this George Zorro principle, right? It's cyclical. Because CEO pay relative to the value of the company, which is a factor, influences the ranking, the scoring of CEO pay. Just move this one over here a little bit. Now the average purchase amount, right? So this is a it's a Cubistic or Gilgard Analytics measurement. The more favorable a company, the more money we're gonna buy into this, right? So right now, the top 100 companies are huge favorites. Bottom are very unfavorable. Industrials is where right now we tend to find the most value. Likewise with the defensive and the materials, communication, real estate, and healthcare are in the doghouse temporarily. Average volatility score per company. So you have the lower the volatility, the lower the number, right? The higher the volatility, you're up there, right? So not surprisingly, you have information technology and healthcare. They're fairly volatile. Utilities, real estate are not. Likewise, the top 100 companies are also fairly low volatility. Speculation, you have the lower the score, the more speculative it is. So real estate, utilities, very low speculation. Materials and energy are speculative in nature. And the average financial score. So I'm going to just stop here and I'll come back shortly.